Rajeev Malik is senior economist with CLSA. He's joining us on the show right now. Rajeev, good morning. Good to have you with us here. Prashant this side. What stood out for you from the RBI commentary, both after the press conference and the conference call yesterday, Rajeev? Anything new we should take away?
Nothing dramatically out of line. I think the focus in terms of the quality of the budget was to be expected. And I think that's really a clear focus in terms of putting the ball very much in government's court. And that was part of the reason why RBI was not going to cut the repo rate ahead of the budget. I still continue to maintain after the budget, possibly even out of policy move of one more 25 basis point repo rate cut is still going to come through.
Right. Okay, just one point before I get to the NPL part. The next target is 5% March 2017. We are at about 5.5% inflation now. Are there enough goalposts which will, for the RBI, I'm sure they have goalposts, but do we know those goalposts in terms of what will be what will make the RBI move between now and the 5%?
Well, I mean, we'll just have to see how the inflation trajectory evolves. Don't forget, while RBI highlights these goalposts, in between those goalposts, the inflation trajectory can actually be quite volatile, whether it's the base effect, whether it's some of the policy moves that necessarily come in. What is more important is that over a period of time, there is downshift as far as trend inflation is concerned. And what typically happens is, moving from very high inflation level, as was the case in India, 10-11%, to almost half that level is relatively easy. The ride actually becomes a lot more challenging when you have to move from, 6 to 5 to 4. So every additional step actually makes it more and more challenging because the built-in rigidities in the system begin to assert themselves, which is why at the end of the day, while we are all obsessed with inflation and RBI, the secret to India's inflation battle actually lies with the government, not with the RBI.
Fair enough. In the policy stance and rationale portion of the policy statement, point number 11, and I quote, they say that the implementation of the 7th Central Pay Commission award, which has not been factored into these projections, will impart upward momentum to this trajectory for a period of 1 to 2 years. I'm not sure how to read this. There is enough and more, research and projections in terms of what this will do to inflation, etc. Isn't that? So, is the RBI saying that we don't know what will happen because of the Pay Commission, and hence we are a bit more hawkish?
Governor clarified during his Q&A that this is cited as a potential risk factor. They're not necessarily saying that is precisely how it's going to play out. Quite frankly, they or anyone else can't really be sure because we don't know the sequencing of the implementation. Now, for example, is the government going to go ahead with the full award in 1 year, or are they going to break it up into a couple of years? Secondly, within the budget, even if some of this boost comes through, are there going to be some counterbalancing steps that try and mitigate the impact? So there are quite a few unknowns, and I think what RBI was trying to do was to highlight a potential risk to think about rather than, everyone just looking at where oil prices are and saying that, India's inflation battle is pretty much over.
Rajeev, you've said many times in the past that for an economy which is growing at, which is proclaimed to be growing at 7.5%, and these are your words, you've said that the economy lacks a certain spring in the step, right? What's your assessment? Many more people now have come up, not just the usual, corporates and industrialists who've argued for lower rates, and I know your view there as well. But many more people have come out and say that this is worrying. What's happening in the economy? Many have kind of likened it to the last crisis. The scary bit is they say that in 2008 there was a huge bubble which got burst and the markets, crashed. Now, what is scarier is that there is no bubble and the markets are just sort of caving in. And not just the markets, but the economic situation as well. Would you agree with that? I just want your thoughts there.
That comparison is grossly misplaced, I would assess. I think what you really have is a situation following a new government coming in and expectations surging into the stratosphere, getting adjusted. Investors realizing that, the complexity of the economic challenges that the government faces despite its focus and good intentions is actually going to take time. There is no quick turnaround per se. But equally, the external environment is a lot more challenging. So, all of that you put together, I think it is much more in terms of reset of expectations happening. There is this, kind of like La La Land fairy tale scenario that new government will come in and there's a magic stick and everything will be hunky-dory. Which was beyond any set of reasonable expectations. And that's really reversing itself in the context of a global backdrop, which, is far from conducive.
So that is, you don't believe that this is...
That is not to say that underlying demand conditions are not very favorable. But all I'm highlighting is, comparing it to 2008 is, a bit of a stretch.
Yeah. No, along with everything that you said, which is, global demand being low, etc. One more negative, of course, is that it would seem that the medicine which was used to treat, the malaise in global markets, etc., which is central bank pumping, the effectiveness of that has gone down quite a bit. I'm not comparing 2008 to what we're seeing now, but I'm just saying that could the effects be as severe?
Well, we have to say how conditions, play out. Obviously China remains a center of attention and rightly so. But I think for India, rather than to keep focusing only on the external side, what we should be doing, given the fact that in a way we do stand out in a relative sense, is to actually further strengthen the whole growth dimension. And one is not clear that that is necessarily happening at a pace which investors had, built in, priced in. So that becomes an important. I think just because external side is bad and we've seen, oil prices collapse is one reason to be positive in terms of macro parameters. But I think people have grossly underestimated what that also means from a micro element as far as India is concerned.
Okay. So you are saying the government, in a way, is to not to blame, but they've not done the things which were required to match the expectations which were built, right? The expectations anyway were quite high and unfair, but the government has not lived up to what it should have as well, realistically.
Well, I think expectations were unrealistically high to start with, and you really can't totally blame the government for that, although I do think, expectations management should have been better. It's one thing to raise expectations in the run-up to an election. It's quite another when you're in the driving seat, because people are going to judge you in terms of outcome. What is interesting in the Indian context is that it's not as if that the government has not done anything. It's actually done quite a few meaningful steps. But despite that, there is this aura of disappointment, which is the point I was making about unrealistically high expectations.
Yeah. No, you said that we should strengthen our own growth prospects and not obsess too much about how the world is shaping up. So from here, the budget is around the corner, Rajeev. The budget or outside of it. What needs to be done now?
Well, I come back. That's the whole fiscal monetary mix in India has always been an interesting one for the longest time. Fiscal kind of like shackled or limited the availability of flexibility as far as monetary policy was concerned. And when this government came to power, for a moment it seemed that there was going to be a long-lasting decline in the fiscal side. which, along with some institutional structural steps to deal with chronic inflation areas, would allow the central bank to actually go ahead with aggressive interest rate cuts. Now, that was the general expectation. It was not something that I bought into, but that was what one was hearing. And, where we stand today, more likely than not, the government will ease the fiscal constraint. But at the same time, while they've done a commendable job in terms of managing the poor monsoon impact on inflation, I still miss some institutional changes that actually makes markets a lot more confident that RBI's 4% inflation target for early 2018 will have a significantly higher probability of being achieved. I think that target is way too ambitious, and it, for whatever we know today, can only be met on an Excel spreadsheet.
Which is 3%, 2018, which is 3%, is it?
No, early 2018 is a 4%, and that remains pretty stiff target because don't forget, it also builds in some recovery as far as demand conditions are concerned, some pricing power returning as well.
No, I'm sorry, you're talking about inflation. You're talking about inflation.
Yes.
Yes. Okay, no, sorry, I was referring to the fiscal deficit roadmap. You said that most likely in this budget the government will loosen the deficit target. You think the governor in a speech made last Friday warned against it. He said if we make a promise, we should keep it. Promise to the market there is. Bond markets will not be happy. Any thoughts there, Rajeev?
I think it needs to be managed, obviously. I think the best possible scenario is sticking to the trajectory that's already been indicated. But if that is not going to be the case, then of the two remaining options, having a budget which has fuzzy math in it but sticks to the 3.5% target stated for FY17 versus slight slippage, but accompanying it with some creative and meaningful fiscal reforms, I think the latter is a preferred option. I think you also have to understand RBI's stance is not fixated on a particular number. It's going to assess the budget in its totality, which is why if you go back to even last year, while the government eased the fiscal constraint, RBI still came through with a rate cut.
Yeah. Is there any just one last question, Rajeev. Is there any scenario in which it could be justified, higher government spending and, loosening the fisc meaningfully would be justified?
Is the operative word. I think the way the government perhaps will present the case is that, the actual slippage, and we are expecting something like, 3.7, 3.8 instead of 3.5, they would take credit and say that, look, this slippage is significantly less than what was implied by the pay commission alone. So, yes, there is slippage, there is one-off impact coming through, but we've limited the slippage, plus there have been some fiscal reforms that have also been announced, which is where you try and make the overall package somewhat more attractive.
All right, got that, Rajeev. Thanks very much. Good speaking with you. Appreciate you joining in with that perspective. Thanks indeed.